Joining us this morning with his market view into next year is Bob Dahl, Crossmark Global Investment Chief Officer. Bob, great to have you back. I wonder what you think about the momentum that has been built yesterday notwithstanding and how long that might carry into January.
It's been incredible. More than 15% in the last month and a half. That's like a good year and a half and a month and a half. All the momentum, it points to the upside. And, of course, the fundamental belief that the Fed's going to lower rates 6 times, according to the futures curve, in 2024, and that's got investors excited. The path of the least resistance continues to be the upside into the new year.
I am beginning to see some pieces, Bob. DataTrek's a good example, and they're not overly bullish, I would say, but they are looking at instances in which you can have a repeat of a 20% year. They point to the early 80s when rates were coming down, and then they point to periods in the 90s where tech was looking at a new structural story. Can you argue that we might have both?
It's certainly possible. There are arguments out there, the roaring 20s could happen this century again. Look, I think a lot of things have to go right, but I'm a little concerned that the market already believes some of that, Carl. Earnings are already expected to be up a double-digit percentage next year. I think that's a bit of a stretch, given the slowing we're seeing in certain parts of the economy. And we're already put a 20 PE roughly on those numbers. So you're going to give me better than double-digit earnings? You're going to give me a higher than 20 PE? I need one of them for stocks to have a really good year next year. I think it's a stretch.
Yeah, I mean, there's also questions, Bob, about what the bond rally is signaling as far as economic weakness. I get that it's a lot of response to the Powell pivot and the rate expectations, but when we start to get to these levels and continue to break south, does it make you wonder about the bond market sniffing out a recession?
It sure does, Sarah. I think we are seeing signs of, fraying. Can I use that? I don't want to be too extreme on the economy. You reported just a few minutes ago, 20th month in a row of leading economic indicators down. Nobody seems to care about those anymore, but when you look at them, they are good leading economic indicators for our economy. Yeah. So I'm in your camp being a little worried about those things.
But I also reported, Bob, that unemployment claims continue to be in the low 200s. Continuing claims are flat. The GDP numbers, even though it was a little bit softer than we thought, is still 4.9%. I mean, the data overall appears to point in a better direction. Even GDP for the fourth quarter is getting revised up.
No question. The carryover from the third quarter is strong, and anyone who says the economy is weak currently has to eat some humble pie. But I think we will see more weakness in those numbers into the first quarter, both the series you just talked about, and I think we'll see. I don't think it's going to be a horrible economy, but we can't continue, I don't think, at these 4-ish% real GDP numbers for much longer.